Season 2, episode 37. What's up, everybody? It's Logan Freeman with your Kansas City Commercial Real Estate Market Pulse, and welcome back to another episode. We're joined by an exclusive guest today, Mark Sinnett, and he is the head of capital markets for Québec at Avison Young, and he's a veteran commercial real estate advisor who has closed billions, with a B, billions of dollars in transactions. He's got a front row seat to where capital is moving across today's commercial real estate market. So we'll let Mark introduce himself more in depth here in a moment. But I'm super excited because, what I try to do on this show is really get through all of the noise out there, try to bring some clarity, because we all know that there is no shortage of headlines, predictions, opinions about commercial real estate. What's missing and what's needed is grounded market-specific insights from people actually doing the work, right? And I think in a very short time frame, we will all have access to data that is real-time and is forward-looking, likely. Right now, we have really backwards-looking data to always be evaluating. And so people always ask, well, what is one of your competitive advantages? I say, I'm here. I'm doing the things. I've got forward-looking data in my head, and by deals that are being done today, not what was done last quarter, right? So that's why the Market Pulse exists. I know Mark is going to drop a lot of great knowledge on that front for us here today. If you are interested in Missouri, Kansas, we've got deals now going in Ohio, Nebraska, Iowa, Arkansas, but generally speaking, the Midwest, commercial real estate, here's our team. Reach out to us. We are growing. I'm excited about that. It takes a little bit of more time from me for sure. But what I'm learning is, just like when I was the captain of the football team in high school and in college, the better that you do delegating the right people to the right activities, the more successful you are for your clients. And that's what we're always about here in the service industry of commercial real estate. So reach out to our team. You know where to find us. We're not hiding, that is for sure. So Mark is here. He's the principal and executive vice president and the head of capital markets at Avison Young in Québec, where he leads the firm's capital markets team, and he advises private and institutional investors on major acquisitions and dispositions. But what I could find, and maybe it needs to be updated, is more than 20 years in commercial real estate and completed over 800 transactions. And so that is just an enormous amount of history, enormous amount of experience that I'm excited to share with our audience today. So Mark, welcome to the show.
Thank you, Logan. It's great to be on the show. As mentioned, I follow a lot of what you do, and very impressed with what you've done. And, I think, and hopefully that'll come through this podcast, probably a lot of similarities in what you're doing and what we're doing here.
Yeah.
And so, super excited to be on the show and to get to connect.
Yeah, we feel blessed to have you here today. Spend a little bit of time talking about the commercial real estate markets. Before we get into the individual kind of asset classes, when you sort of look at the market today, and my wife is always telling me, the last 6 years have been anything but normal, from a lot of different perspectives. But really in commercial real estate, there's no truer adage, right? Because every single year we have been battling, all of these different headwinds, whether it be geopolitical risk, multiple of them, interest rates, right? Just so many different things to kind of work through. So let's maybe start there. I don't need you to prognosticate on exactly where we are in the cycle, right? I've had people on to do that, and we have fun, forecasting and bringing out the crystal ball. But let's look back the last 6 years. We're 2026, mid-year right now. What's going on in the commercial real estate, capital markets, and maybe talk a little bit about where we're at in the cycle.
Yeah, I mean, I think with what you said at the very beginning, I don't, and I have been doing commercial real estate brokerage since 2001. So just about 25 years,
That's awesome.
this year. And it certainly feels, and maybe that's a recency effect where, it's easier to look back to, a couple of years in the past and, prior to that, but it definitely feels like these last few years, the amount of volatility, things that we would have never predicted or we would have never factored into how they could impact real estate or how they didn't impact the actual value of a real estate property, and again, here in our market in Quebec, which is, not exactly per se a gateway city that's at the forefront, so to speak. It's crazy. And,
Yeah.
I said this on another podcast, and I think, where I really have seen that in my day to day is I used to remember where I could give a client an appraisal or an opinion of value, BOV, whatever we call it. And, I was highly comfortable that like in the next 6 months, the value was pretty spot on.
Sure.
And, again, like today, like this week on Monday, I think the bond market here in Canada changed by 10 basis points. So when, how does that impact the financing on, we're relooking at every one of our deals and saying, how's that impacting if someone needs the rate lock today? So we haven't, I feel like that level of volatility is certainly something that we've dealt with in the last 3 to 5 years, not something that we saw so much prior to that.
Yeah.
And then conversely, kind of like, I don't know if you're seeing this, Logan, but like I'm also finding at the same time that the deal cycle is actually taking longer.
Mm.
And, whether that's, people are being more cautious. So they're getting maybe more comprehensive reports on the enviro, on the physical condition, titling. But even just legal contracts, I find, are taking forever. So, our role, it's become interesting. Pricing is moving faster. Deals are taking longer. That, kind of creates a lot of uncertainty or sets up a recipe for uncertainty in the middle of transactions. And so I do find that's kind of what we've experienced as a brokerage outfit over the last 3 to 5 years.
Yeah, that's well said. You take one of the components that we have had to deal with in the commercial real estate market. Let's just call it geopolitical risks. In the past 3 to 5 years, we have had 1 to 2, maybe 3 of those major kind of red flags that would create the uncertainty for these transactions all at once, or right when you get through one and you think it's done, something else comes up. And so that's the really difficult component of, like what you mentioned, what we're doing with advising clients. I have seen more and more unpriced assets. That seems to be because I think people are like, well, shoot, I think I have a good idea of value and I can look at historicals, but I don't know what's going to happen in our 90-day due diligence period, right? So what happened, I think maybe 2 years ago, maybe even 3 years ago, is sellers were not willing to negotiate. But at least I have seen give and take on both sides to try and work things through. And I think that's maybe the investor sentiment that Howard Marks always talks about that's very hard to quantify. But that component of people trying to make deals is at least somewhat positive. Not everyone works out, but it does seem like sellers and landowners are at least cognizant of we are in a volatile market, and we have things that we have to think through, and so do a buyer. So I think that's helpful. The other component, go ahead, Mark.
Oh, I would just say, I think you got to separate, I always like to tell clients, I think we got to separate two components, and they interplay. And it's funny because we are in the process of putting together a white paper to kind of demonstrate just how much they interplay. But you can, as you mentioned, the macro, or, what I would call is effectively that, the kind of the macro context. And then there's what I like to term the fundamentals. And, I think and I always look and tell clients, like, look, real estate is, in theory, is not meant to be a buy, flip, or a buy and trade. That's equities where you can sell very quickly and buy very quickly. If you're buying real estate, you should be looking at, 3, 5, 7, maybe 10, maybe forever, but you should be thinking long-term. And if the fundamentals are solid, be it that, we've got positive demographics, the economy's growing, leasing rates, there's constraint on actual real estate being built, and so on and so forth. The macro, unfortunately, it based on the analysis that we did, it almost affects pricing by about 65% or thereabouts. But the reality of it is that's not going to necessarily determine the performance of your asset.
That's
When I
right.
mean your asset, like what rents it'll get, what revenues it'll generate, it will impact, and that's where it's more relevant to you and I, it impacts the price on day one. Again, as great as your asset is performing, if you've got, terrific rents, and you're fully leased, et cetera, you're still going to be constrained to what the market feels the value is. So there's a certain amount that you can influence by performance and operations, but then the macro really influences the price. And so to your point, the geopolitical events, I remember it's a completely anecdotal story, but just to show in real time. A client of ours was telling us the story where they were on the verge, I think it was trading an asset to a foreign sovereign wealth fund, if you will. And about 2 days before the LOI term sheet was going to be signed to the sale, and it would have brought this sovereign wealth fund, I think, for the first time to Canada. The equivalent of our Secretary of Defense, Secretary of State, excuse me, in Canada, went out and made a comment against the country, and they basically ripped up the term sheet.
Wow.
So, and it would have been, I think it would have been something like a $3 billion acquisition. I wasn't involved or anything like that, but it's just anecdotal where, something that someone in the head of government says, to a news article ends up, killing an LOI term sheet downstream. So,
yes,
you hear those stories and it gives you pause for reflection, if you will.
So if I may just double click on kind of this main point here for the audience, I think the takeaway is fundamentals and in sentiment because of macroeconomic either markers or news articles. They're two different things. Your fundamentals of your real estate, but what you're saying with your white paper, I've not heard. That's incredible that you were able to quantify this, but like up to 65%. It has a valuation, it has an impact on your valuation.
Based on the sentiment, which is predominantly driven by the macro.
Which you can see now why it is so difficult for owners to say, well, I'm performing extremely well. But then 2 weeks into the listing process, something happens. And so I think those are a great lead in kind of to our next point, which is when that volatility is present, and there is dislocation in the markets, there are opportunities. And, there's obviously, different asset classes that have really performed differently based off of some of these different tailwinds. But what I wanted to ask you is, if you're following the capital instead of the headlines, what are you seeing in regards to your markets on the asset classes that are attracting kind of the most serious investor interest right now, that they're saying, look, we've been in the game. We understand there's headlines all the time. We are sticking to the fundamentals. So what fundamentals in the asset classes are they kind of flocking to?
So I think the first thing I'd say, and you mentioned at the beginning, and I think it's entirely, it's a point worth restating. I think our role, what I do and what you do, Logan, is we have the benefit of real time. We see on a day-to-day basis, like we see pricing coming in, we get the offers, so we can really understand how buyers are thinking in real time, not based on a transaction they did 6 months ago when the environment was different, the sentiment had changed, et cetera. I would tell you right now, if I look at what we've got on the market, where we're seeing the most level of activity, and I'll kind of touch on how I see that play out. I would say right now, retail seems to be the darling of the asset classes. And I think it's at an interesting inflection point where, we're really, seeing, how would I say, again, going back to that sentiment, like we can underwrite an asset, put in, MLAs saying, look, we think that rents, on this asset when the option comes up or when their lease expires, we think rents are going to grow by 30%. And we're not necessarily getting a pushback from our purchasers. Maybe we'll get a little debate, we think that's a little optimistic, or you didn't factor in enough TIs to get that. We can get into the nitty gritty, but we're not getting an outright you guys, you're not seeing the market correctly.
Sure.
And The funny thing is, again, like I've been through, I think now I'll say 3 cycles, like large cycles where I've seen, people roll in and out of asset classes. Going back about 10 years ago in our market, if you go back to around 2015, retail, Sears went bankrupt. I think they did in the US with you guys, but that put a ton of real estate back on the market. And when that happened in our market, there was a lot of concern. How is this going to be absorbed? The cost, the this, that. We just had the largest department store called the Bay, which is owned by the same group that I think owns Saks. So they basically shut down in Canada, and they put back about the same amount of square footage as had happened in 2015. It's had no impact on the market.
Yeah.
And so the sentiment in the market 10 years ago is all this space, who needs it? What's going to happen? The sentiment now, because there's been no construction, we've had 10 years of effective absorption or conversion. Now the sentiment was like, good, we needed the space and there's demand for it. And I think through 2020, as they thought it would be with COVID, the retail apocalypse where, nobody was going to go shopping. We were doing everything online. I think a lot of the retailers that are out there today are solid retailers. Balance sheets are secure. They've taken market position or dominant position in their retail space. And as I like to say, there are no bad retailers anymore. Now, it's a generalization. Obviously, there's still stores opening and closing. But generally speaking, if you read 7 out of 10, quarterly reports on publicly traded retail, they'll tell you they're all expanding and they're looking to expand. So I think right now, retail, from an investor sentiment, there's a belief that, at least in our market, and I believe it's the same in the US, that, retail is on the up. And then I'm looking at this slide, and I think the multifamily sector is a fascinating one. And I talked about it recently with the guys at Good Life. I think multifamily is heavily influenced by demographics, population growth.
Absolutely.
And so when you look at, and not to comment on the political side of it or to give an opinion on it, but when you look at things where you're saying, what, we did it in Canada as well, where we needed to rein in or control the amount of visas that we were giving out for students and the amount of visas that we were giving out for temporary foreign workers. And I think there's been a bit of that going on in the US. It's going to hit the multifamily sector. It's just going to take demand out. So we see spots in the multifamily sector where there is a little bit of softness.
Yeah.
Maybe at the more high end, maybe in more urban environments where you would have a greater population of foreign workers or temporary visas, temporary students, et cetera. But again, if I look at the fundamentals in the long term, like, US is a growing country, so is Canada. You can't build as fast as the population is going to grow. It'll right size itself. So my perspective, if I'm a disciplined investor, now is probably the right time to look at multifamily, because you're probably going to be underwriting the value relatively, I don't want to say, maybe it's conservative, but the way you're going to underwrite it is not going to be with, very aggressive metrics. Right?
Sure.
So, that's when I say, that's why I like to say sometimes it's a good thing, right? Like, if you're fundamentally thinking like, I have to be conservative, I have to hedge, and you can acquire based on those metrics, well, when things improve, you're going to benefit from it.
Yeah, absolutely.
And then I just to touch quickly on the other two, I would be long, if I was to say it that way, on office. I think the office market, we've been through the worst. I think we're in the early innings of office sector coming back. Some people will argue, that AI has created another type of uncertainty in that sector. I think people want to go work somewhere where, they're with other people. I think that's just human nature. And I think what COVID really did is it forced companies and it forced owners to modernize their buildings. And so I think I look at the office space we're in today versus the office space we were in 2019. I mean, night and day.
Absolutely. Yes.
So, and I think for major corporations and for large institutions, having a workspace that creates a culture or creates an environment that everyone can get into, I think there's still value in that. So, I would say I think it's a good time to buy office. I think a lot of the pricing is going to be benchmarked, going back to what we talk about on values that were transactions done at an opportunistic level. And I think we're starting to see office, if you look at the fundamentals, AAA office is like 6% vacancy, in most of the major markets you look at. And so you're starting to see, space get taken up in the A- and B+ class office buildings. And, but your pricing, if you're a seller, you're not getting that value, that core plus value price range. So that becomes interesting where, again, there's maybe a bit of an arbitrage where you can buy closer to opportunistic value add pricing on an asset that's actually performing more like a core plus asset.
Yeah. Yeah. Well, very informative there. I've got a lot of thoughts on there. I just want to bring up MD Omar Farouk is saying very informative. Thanks for being here, MD. Multifamily for me is a very interesting asset class. And I just want to give a shout out to Chris Porter and the team at John Burns Consulting. They've been on the show. And you mentioned demographics and psychographics being extremely important for that asset class. The fact of the matter is, if you read Big Shifts Ahead, you'll start to understand, where the multifamily opportunities lie. And I do believe there is a push back to this suburban, to use their term, which is suburban urban. And so I love that, because if you're creating community around multifamily properties, and so beautifully designed multifamily properties that are walkable and around public transit, probably doing very well. But the days of just buying a multifamily asset and trading it in 18 months, that's over. It's been over for quite some time. Yes. And so you really have to get good on your operations. So the last 5 multifamily opportunities we have either had the opportunity to work on or I've talked with owners on, they're all getting very serious about their portfolio optimization. And with the advent of artificial intelligence, there are so many new tools to be able to do so. Retail, couldn't agree more with you, Mark, there. We were buying actually retail when everybody's saying, retail apocalypse. So I still have 5 or 6 shopping centers that are just screaming along and doing.
And they must be performing amazing right now.
They are, absolutely. And it's this, neighborhood retail shopping centers that cannot be replaced.
Correct.
You really just get down to supply constraints being there, but also you want to be in the right locations. Office, great advice there, and I think thesis on the office side. We are also seeing, at least in the Kansas and Missouri markets here, offices that are highly amenitized are bringing people in, and it's an ecosystem. The coffee shop, the work, the flexible workstations, hey, let's meet at the office building instead of going down to the Starbucks. Those are really succeeding, I think, extremely well. And I think that from an industrial standpoint, I'd be remiss to not just, speak to most of the work that I do in my practice, which is, sort of industrial, but a lot of data center work within the industrial side. This is an infrastructure super cycle like we've never seen before. But I think what people actually miss on, they're like, well, I can't really play in the data center space. For a gigawatt, it's $50 billion. We're going to let NVIDIA and those guys do it,
exactly,
right?
Yeah.
But think about this. In what we have been doing and advising our clients, if you know of a property that's going to be developed as a data center, what are the second order effects of that? Meaning, where are the laydown yards, the outdoor storage, the advanced manufacturing? The company that's going to get that bid and actually build that thing, they probably need to build a dang concrete plant next to it,
Probably, yeah.
So the industrial, I know at least here in Kansas and Missouri, the industrial market has just absolutely outperformed here recently just because of the data center build out and the need for that. It also presents a really interesting opportunity for current landowners and building owners to figure out their power stories at their buildings.
Yeah.
because there is a major opportunity. I think the next 3 to 4, 5, 10 years, we are in all of our offering memorandums. How many megawatts does your building have? I mean, it's going to be a line item in the OMs.
Yeah.
You know, what's the not just do you have heavy power, do you have 1600 amps at 480 voltage, with 3-phase? So I know that I have 1.5 megawatts of power there, right? So that's a trend I think that we need to keep our eyes on, especially with the advent of drone deliveries, with autonomous vehicle fleets. All of these places need power and they need to be connected. So that's all I will just add on the industrial side. It's very exciting.
Listen, I think it's incredibly interesting. The interesting part of that is that here in our market, our energy source is entirely hydro, so kind of
Yeah.
clean energy source. Unfortunately, right now, they're not giving up the power or giving out the power, so to speak. So we're not seeing that level of activity where we could or should be from the perspective of, we have clean, renewable, we have a very strong infrastructure for it. The government here has just decided, I think, to be a little more cautious. There was recently announced in Alberta, they're doing like a $13 billion plant from Meta.
Yes.
And I think Meta is going to build literally the power plant, the natural gas fired power plant next to it. And I think exactly like you said, it's probably 7 to 10 years going to generate over 3,000 jobs. You can imagine the number of, as you said, trucks that are going to be needed, construction workers to build this thing, and they're all going to need space. So, I do think it definitely has a trickle down effect into the industrial. And my only comment on industrial is that right now it's it in our market it peaked, I would say, about 2 years ago, based on and I think that was a big influence on COVID, where everybody went from using services to all of a sudden having nothing but the ability to purchase hard goods, and so that just required a whole ton of inventory and space. But again, I remember when I started in 2001, the industrial market in Montreal was 330 million square feet. I think it's 340. There's been no new construction. And that's where we really saw all of a sudden price start peaking, because, the economy kept growing. So businesses kept expanding and we weren't building. So, and I think, as you say, if we head into a super cycle of data centers, which I think you're right, there's some very strong indications that is, a cycle that we're heading into. I mean, with everything that's been announced, it's in the trillions. That's going to have some major and massive trickle down. And where it's interesting, I think, for your market, sorry, just to continue the sort of the flow here, these data centers are not necessarily, needing to be in, gateway cities, coastal, etc. Right? So it actually, might be the return of a boom in more of the, whether they used to call it the Rust Belts or the Midwest or things like that, which is very interesting, right? Like back into the heartland, so to speak.
Yes. We are part of a project out in rural Kansas. And it's been an incredible feat to get to the point where we are. 283 acres, $12 billion project.
Wow.
But it takes a lot of public relations work. It takes a lot of due diligence up front. There's a right way to do it and a wrong way to do it. And, frankly, the fact of the matter is that one project will more than double that city's annual tax revenue. It will also generate over $10 to $12 million for the school system. And I just saw on LinkedIn today a city, I don't remember exactly where it was in the United States, and they said, look at all of our new stuff. It was a brand new state-of-the-art school, road system, public transit, a stadium that looked like it was an NFL stadium, basically, in rural America. Now, again, not every town wants that, okay? And I understand that. But I do think there are towns that are raising their hands saying, this is our chance. This is our opportunity, and we are going to take advantage of that. So we've done many shows on data centers here with experts, but it is something that, as commercial real estate practitioners, investors, developers, brokers, we cannot ignore. It is massively important. And we've also spoke to Ricardo's Law of Economic Rent at length on this show. And that is exactly what is happening right now. New infrastructure is being laid, which then the landowners around them are the beneficiaries of that public and or private now infrastructure being developed. So something to absolutely keep our eyes on. And what we have seen is quite the land lift per acre on industrial land just because of the data center work.
Yeah.
So,
and look, it might trickle to multifamily. If you're talking about shiny cities, that have great civic, whether it's civic center or civic services and solid school district, you might want to move there, right? And so, that's going to create a little bit of a population boom, right?
mm-hmm.
So again, in some of the older cities, you see it, like the infrastructure is worn down. It's in our market, you can't get into a hockey arena. This neighborhood doesn't have an indoor aquatic facility. You start to put all those things together, and I think that helps also incite people to move to those neighborhoods.
Yes, it does.
Jobs and good schools. I think those are kind of two big drivers. And then with the population comes the retail and everything else that comes with it. So, yeah, I think it's, it goes back to how we started this conversation. I mean, it's just the amount of change that's happening right now and the speed at which things are happening. Again, and I don't think it's going to slow down. I think this is the world that we need to do business in.
Absolutely. Well, we got a listener question in here, specifically around buyers and sellers and finally meeting, right? We always talk about this bid ask gap that's out there, yes. Right? And how big it is, right? We've got a good representation here. Thanks to Katie for our team putting this together. But really, the question is mostly around how much has the gap between buyers and seller expectations actually narrowed, right? And are we seeing enough price discovery now to bring meaningful transaction volume back? And if you'll just let me opine on that for one moment. Ahead. The only thing that I always try to point back to is leading indicators from a company that I work with called Lightbox. And they put out great information in regards to tracking environmental reports, appraisal reports, and new listings on their platform. And from June to July, it was quite the drop. But up from January to June of this year, leading indicators were in triple-digit territories and all very, very good, healthy metrics. So we are starting to see a little bit of a drop, but I think that was some of the impact of the war in Iran and the Hormuz Strait and legitimate concerns around the 10-year Treasury here, at least stateside. Yeah. So, but I do want to, just kind of get your opinion on this. Is a great question, and have we narrowed, or are we still kind of, far apart?
What I would say is, again, I think I look at it asset by asset.
I think you have to.
So I would say in the retail space, the bid-ask gap is almost non-existent. In fact, it's the one area, again, where we're seeing probably overbids. When we give a value range, we typically say, like, here's the, kind of base value, here's target, and here's kind of a stretch value. And the stretch value, we typically, usually that's the only number the vendor remembers, by the way. I don't know.
Funny how that works, isn't it?
Yeah, exactly. And how we like to think about it is we say, like, look, if there was a marginal buyer, let's say there's that, like, one guy that needs to buy this. I don't know. He's the neighbor. He's the tenant in the building. Sure, it's the guy that drops in from Mars that, is just buying into the market. And there, you can get lucky, right? Like I like to tell clients, I said, listen, you might get lucky and sell at a price that, isn't market. But that's not, my business isn't based on, getting lucky on, 60, 70 transactions a year. I think in the retail space, we're getting to the point where, we're probably going to adjust our underwriting and push values a little bit higher. So, compress the cap rates, if you will. I think, again, as I mentioned on office, that's where I see still the biggest bid ask. And in our market, industrial. And that one's an interesting one, because I've already touched on office, but where I find it really interesting in the industrial space is it's not that anybody disagrees with the value. So if I ask a purchaser, what do you think the value is? They'll say, I think, and I'll just throw a number. They'll say, I think it's a 6.5 to 7 cap, let's say for our market. And then I'll ask a seller and I'll say, what do you think your property's worth? And he'll say, I think it's worth a 6.5 cap. I'll say, great. And I say, yeah, but I won't sell it that. I'm like, and there's the problem.
Yep, there it is.
And then when you kind of dig in, so you kind of dig in and you say like, well, what's happening here? It's like, well, the truth is the industrial is doing okay. Like it's well leased. I think we've got 7% vacancy in our market. Rates are not necessarily growing right now. Like we're not seeing rates, like we went from a market of $5 rents to almost $21 rents.
Wow.
within 6 years. And our rents have come down. They've come down to about 15, but that's still 3x over what it was less than 10 years ago.
Absolutely.
And it's been flat. It's kind of like 15 market. Everybody accepts. The tenants can pay it. The landlords can make money on it, so everybody's good. But I think what's interesting is that if I'm sitting with a property that's rented at 15, it's got a 4-year WALT, it's fully leased, maybe at that 6.5, 7 cap, it's just not enough for, like, I'm happy with the revenues. Keep going.
Mm-hmm.
And on the flip side, I don't think the buyers are not necessarily convinced enough that if they pay a little bit more, let's say a 6 cap, they would be able to get their revenues in 3 years to that 6.5, 7 cap that they believe the value is.
Sure.
So I think when you say bid-ask gap, I think the industrial one is the most interesting because nobody necessarily disagrees with the value, just nobody wants to transact at those
That's
values.
exactly right. Yeah. Yeah. The other thing I'll throw in there, Mark, is, well, what am I going to trade into? It's like that. I don't know. I mean,
yeah,
because if everything is 6.5, 7 cap, I'm going to keep. And I understand that, which kind of brings me to the next point of, at least here in the United States, we've started to see, what's driving transaction volume is, loan maturities and refinancing pressure.
yes.
Right. So like, that's really, in our market, in our game as brokerage, it's like, well, yeah, everybody agrees on value. I'm still not selling. Like, you can't do anything about that, but you can ask about, well, when's your loan come due? And then, most of the folks I work with say, well, I don't have any debt on it. I'm like, well, gosh dang it, I'm just screwed here, right? But at the end of the day, it's about understanding long-term perspective and what they're trying to accomplish, right? I'm helping a large owner right now consolidate mixed-use office, medical office buildings into all industrial, just to simplify operations, right? But I think that's the thing that people have to understand is what's ultimately getting, people to transact is really loan maturities, refinancing pressure, maybe a need for liquidity on something else that's out there. And so we just have to, it's a numbers game, and we have to continue to interact with more and more people, right?
And again, you're absolutely right, because again, go back to that industrial, you're happy at the lease, it's got a 4-year WALT, it's well leased, you don't have to worry. You're not selling now, but then as you say, either the lease comes up for renewal and all of a sudden you didn't renew with any lift, or your loan is coming up and the bank says, well, based on appraisals, we're not going to give you any more money. And you're kind of sitting there, well, I'm going to be stuck for another 5 years.
That's right.
I didn't take out any money. My rent is flat. So yes, there has to be, I think, again, for pricing, I think in our market, in the industrial space, it's just time will, I think, bring back the normal investment volume because it is significantly low compared to historical years. But that's just an example where, again, we don't disagree on value. We just, no one's ready yet to trade at those values. And when loan maturities or lease maturities come, we think that'll kind of bring back the market. Whereas on retail, we're being asked on a regular basis for BOVs on retail because people think they can sell for more than, or for a better price than they've been told for years, right? And so they're finally willing to exit at numbers that are appealing or attractive.
Yeah. Makes sense. Yeah, absolutely. Well, I want to get into what a little bit of, because my last slide was really something that we've already discussed, which is basically every asset class and best opportunities. We've been at length there, and I'm glad we have. But after 800 plus transactions in multiple market cycles, what have you learned? What do you I think we have a lot of people here that like want to know how to interact with brokers. How do I build the relationships? What do the best buyers consistently do differently that is allowing them to get on your list? And when you have a new deal, Mark's team is calling me because they know I can perform, or what is that point there, right? I think that's a question I get all of the time.
That's a great question. What I've learned over the last 800, I think I think I can't say that I've seen every single problem, but I've definitely seen my share of, things I didn't expect, or, something new I've got to kind of deal with. I would say, to answer your question though, the first question you asked, so how do, what I like, a lot of clients that I've built a really good relationship with have, and I would suggest this if I was any investor, is almost the idea, listen.
Mm.
The broker is typically, I like to think, our role is to especially if we're working on the sell side or the vendor side, our role is really to kind of analyze the property and figure out, if you want to say simplistically, the highest and best use. And, I think a lot of clients that we've had success with, maybe at first, it's not the asset class they were looking for or anything like that, but they took the call. You lay out where you see value, why you think this price makes sense, what the upside is, where you think, the potential value creation opportunity is. And then they've kind of, some of the guys have come back and said, you know what? Yeah, I think that makes a lot of sense. Tell me what I need to do, to get it, so to speak, or how do we move forward? And I think, those clients, we've probably done 5, 6, 7 transactions, built a portfolio with them, surpassing 100, 120 million. And you get some clients that are always going to call and just argue with you. Value is this, we don't agree with it, and I don't know that that advances. Like it's hard to do a transaction with someone who basically on the start is saying your numbers are wrong, your value is off, you know, I understand you want to negotiate a little bit, and we know that's part of it, but it's different than, being someone who's like gonna, disagree, and your heart, you lose the confidence. Like, are we really going to do this deal or not? I don't know
Right.
how else to say that. And we get a few of those where it's like, we'll give them, what we think is the opportunity, and what we get back is, it's not that great of an opportunity. It's not going to work. And we sell it 3 months later, and they're like, I really wanted it. Why didn't you work with me? And it's like, well, you said you didn't like it. I don't know. So I think, and then what I will say is, and this stuck with me at the start of my career from a much more senior broker. And so I always remind myself when I really feel that like things are not going. He said, in doing a transaction, when you start, you are 700 no's away from a yes.
Mm.
And he threw out a big number, and he said, you just got to know that there's always going to be an objection. There's always going to be a challenge. There's always going to be an issue to resolve. And your role is to just kind of, move the chain, even if it's by inches, just keep moving down the field.
Yeah. I like that.
So that's how I after 800, and I think I'm close to like 900 transactions. It's like, and then now, like, you get to the point where there's things that you're able to pull an experience from a previous file where you were able to resolve an issue, or there was a solution that came up through another file, maybe a legal term or a legal position, or in fact you met a professional like an environmental expert that was able to do a proper risk assessment. And so now you can turn around, call them up and be like, does a risk assessment, we know it's contaminated, but could we do a risk assessment on this site, and would that work? So it's there's a lot of that where you can pull in, from previous experiences, solutions or strategies that might get you past that current obstacle.
Well said. I appreciate you sharing that insight. Let's move on to our quick takes, my favorite section of the show. Do you have a favorite book or one that you recommend most often to people?
Ooh, I do. You know what? It's one that I've recommended quite a bit. I read it earlier when I was younger, and I probably pick it up every 3 years. It's called On Equilibrium. It's written by John Ralston Saul, who's a Canadian philosopher. And just, it's exactly what it says. It's basically, it's a bit of a philosophical book, but I think it gives some keen insights into, kind of how to, live your life, in a way that's positive, and that's, thinking long term, so to speak. So that's one. that I recommend.
I love that. I have not heard of it, so it's going to be on my list. On
Yeah,
Equilibrium. Got
Equilibrium.
it.
Yeah,
Okay.
I'll send you the link afterwards.
Perfect. Thank you for that. So we talked about some trends and shifts in commercial real estate, but anything that's recent that's most exciting that you're seeing right now? Anything stand out?
Look, and this is just kind of like a personal opinion. I would say the one that excites me the most, whether it excites me the most or I think the asset class, if you will, and it's a little bit of a niche asset class. I put it in what I would call the alternative bucket, and I do then think it's a general trend that I would leave out there. So I think the hotel space is a great space. I think experiences, I think with technology, whether it's, the platforms like Airbnb, but just the ability, to kind of like, and I think people are looking for it more, right? So generally speaking, I think tourism is up in most markets. Generally speaking, again, a lot of the hotel operators are doing phenomenal. And I think it's a space where, and it kind of leads to what I think where some of the other industries we'll get to, maybe industrial being the least one, but more and more people are looking for turnkey. And I think you said at the beginning in multifamily, where it's like you really want an experience, like you want this, you're not just looking for the commodity anymore, you're looking for the community feel.
That's right.
And so, I think if you're a hotel operator, you understand that at the top level of what, delivering full service turnkey is. And I think more and more, like even with retailers, like, one of the very successful concepts that's gone around the world is this timeout market. So it started in Lisbon, but it's basically, it's a very, high end food hall or cafeteria.
Okay. Yeah.
But the interesting thing is the owner effectively runs almost everything. So the tenant shows up and cooks, right? But the point of sale system, all the TI, all the machinery, it's all the landlords, right? It's their staff that's picking up the dishes in the food hall. And I think, but when you look at the rents that they're getting and the sales performance that they're doing, you would never get that on a net rent basis. And so I think what we're seeing more and more is that, for certain markets, whether it's, in multifamily, people will pay more, if everything's in, the heating, the electricity, the Wi-Fi, if it's all included, community services. We're selling a building now where included in the lease is 2 Teslas. So you have 4 hours and up to 50 miles. You can reserve and take the Tesla and go where you need to go.
How about that?
Yeah. And, when you think about it, you're like, this is it's a high end, kind of a bit of a luxury property. And you're looking at it and you're saying, you know what, like, I think if I was looking at it as, I come into town, I work 3 days a week in town, and then I work 2 days, in the suburbs or somewhere else. This is what I want. I just bring my, my suitcases, everything's on site. I've got a gym, I've got a pool, I've got 2 Teslas. Not that I need to drive 2, but they're at the service of the 300 tenants. And I think that's where we're I don't want to, maybe it's a big jump to say that's where we're headed, but I think landlords that operate and are willing, and are not afraid to operate, or not afraid to really enhance the value of their real estate by being operators, I think they will get better quality tenants, better rents. And so that's why I look at the hotel space and I think there's, they understand that fundamentally.
Absolutely. I have not heard of that, and that's really interesting to me. But we are working with an infrastructure company deploying fast DC chargers out in Kansas and Missouri, and it's just another way for them to have more dwell time at their properties, right? And
Yeah.
it's just things like that that can be added and accretive to the real estate deal. Very cool.
Yeah.
Learn something. Absolutely. So last one that I'm going to ask you, it's kind of a fun one, but if you weren't in commercial real estate, what do you think you'd be doing?
If I wasn't in commercial real estate, what would I be doing? Probably some other kind of sales.
Yeah.
I don't know what. I think fundamentally, even before graduating, a lot of the jobs I had part-time were in sales. Or I'd be some type of entrepreneur, maybe running a restaurant or a coffee shop or something like that.
Yeah. Well, Mark, thank you so much for being here. Point people in the right direction so that they can follow along and learn more about what you do and where they can find you and contact you.
Yeah, so easiest is by email, my name at mark.sinnett@avisonyoung.com. My LinkedIn profile is Mark Sinnett. Those are probably the two easiest ways to find me. Quite active on LinkedIn and happy to connect and
Man,
follow with anybody.
we just barely scratched the surface today, but Mark is a busy guy. He's got a lot of knowledge, and I'm just glad and feel blessed to be able to spend close to an hour with him, with our audience here today. So thank you, Mark, for that. And I appreciate everybody tuning in. It's been another episode of the Kansas City Commercial Real Estate Market Pulse. We'll be back here live again on Friday of this week, talking about a 3-property portfolio of multifamily in Arkansas, and our good friend Bryce Richardson will be here. So, Mark, thanks for joining us today, and thank you for sharing all your wisdom and your insights. It was a great deep dive, a great snapshot of where we're at in commercial real estate today.
Hey, thank you so much, Logan. It was great to be on.